Okay, any questions about anything before we get started? Okay, I'll leave some administrative details towards the end because I think there'll be more people interested then. So, what I'd like to talk about today is, again, it's the last lecture, and I think I like the last lecture to be interesting. Okay, ideally I like the whole course to be interesting, but at least the last lecture. So today we're going to talk about a interesting topic that is really kind of fundamental in any, let's say, investment strategy that people like us are likely to, let's say, underestimate. Okay, is the question of managing, how you manage money. Okay, by this I mean when we look at trading strategies, usually the idea is, oh, is there a profitable opportunity? Is trying to detect a profitable opportunity. And most of what we've talked about these days have to do with questions of, most of what we've talked about all semester had to do with identifying profitable opportunities. Like, for example, in an arbitrage situation, if I had something where I guaranteed myself a profit, how much should I invest in it? The answer was obvious, as much as I could. Okay? Before it went away. But in a lot of other, let's say in real investment opportunities, you have a world where you have a finite bankroll. And the question of, again, how you allocate your investment portfolio over different, let's say, possible investments, okay, has been implicit somehow in risk versus return. You know, the idea that somehow that, do we put a lot in a risky, somehow there's a trade-off of risk versus return. We got into the issues of portfolio optimization, okay? And there was then a question of then, how do we allocate our money so as to achieve, the best return for given risk or best risk for given return? When we looked at some other investments, the issue was market saturation. This is when we start talking about transaction costs. There was a limit to how much I could invest, and at some point it would come back to haunt me, okay, because I would be changing the market prices. So those are places where money management issues sort of were implicit in the discussion. But I'd like to talk about a couple of, let's say, other ideas where money management has become an issue. And again, I will argue that in some sense allocating capital to the right investment opportunities, can be more important than finding them in the first place. So if you see that you have 25 great ideas, the question of do you spend 1/25 of your money on each, or how much you spend on each, really is arguably a more important problem. So the first, let's say, issue that I wanted to talk about, which I've mentioned several times here, but I wanted to make it concrete, was that that there is where there is a trade-off, an issue of money management has to do with how you use leverage. Leverage, remember, was borrowed money. And there was a question of when you borrow money, okay, the idea would be that if someone will lend you money that you can then invest, in some sense, if the interest rate is X and your expected return on your investment is greater than X, in principle, that's an argument that you should borrow as much money as you can and invest it. Your expected value, if I can borrow money at 5% and I can earn an expected value of 6% on it, that would be an argument that maybe I should borrow as much money as possible, okay? Because I'm, guaranteed and clear. And the trouble is the magic word expected, okay? There is a certain level of risk involved because an expected value, the fixed cost of borrowing money is fixed. The returns on an investment like stocks or something like that, even if it's expected to be greater than the interest, that fluctuates. And so one way to see it is if we start to try to look at what happens when you look at a leverage trading strategy. So here, I had my rapid response team, actually Yan Yan was the hero here, look at the question of what would happen if we borrowed money at, let's say, the LIBOR rate, which is a nice low rate, but one that fluctuates, okay, for a year. And we took that money and immediately invested it in a stock market index, let's say the NASDAQ index. in general, I mean, undoubtedly, historically, if you look at what NASDAQ has done, this is what NASDAQ has done. Historically, there has been a growth rate. That growth rate certainly exceeds the average interest rate that you can borrow money at Leemore. Okay? And so the left picture would show us what happened to the NASDAQ up until the end of last year. Okay? The other side would show us the fluctuations in the interest rate. Sometimes the interest rate is relatively high. The highest one we had there was about 9%. And it got down to almost 1%, at various points in the period. The question is, what would happen if we decided the bank would loan us money, okay, at a certain leverage factor? What would happen to our returns? And this is sort of the computation that we did. It's kind of interesting. I'm going to show you two different periods, the decade of the 90s and the decades that we're in now, okay? And what this graph is showing is what would be the annual return if we played this game where we're borrowing money at a fixed time for a year, putting it in the bank, okay, and then waiting a year, okay? Now the trouble, of course, is you can't wait a year because the bank is going to get upset if you borrow $1 million from the bank and you have lost the value of what you have. You have to put up some collateral. That's sort of this leverage factor. You have to put some money in. There's, you can borrow some multiple of that, okay? But when your total wealth goes to zero, when you've used up all the money that you have invested, the bank will then make you sell and wipe you out. The bank is not interested in taking a big loss, okay? So the problem with a leverage factor is not that on average you will do very well, okay? But the concern is that the moment you drop below zero, that's when the bank will take your money away, okay? So let's look what happened. This is sort of showing us what our returns would be for different leverage factors. The blue line, which I guess you can barely see. Let me explain. We're borrowing money for a year. So let's say what we're going to do is the following. Here, let me try it again because I didn't make that clear. You have X dollars. You can sweet talk the bank into loaning you, okay, a certain multiple of X, L minus 1X, okay? And you're going to put this into the stock market. The moment, at the end of the year, 1 year from now, okay, you will sell the stock, use the proceeds to pay off the bank.
So you're putting your X in this.
You're putting your X in there also, okay? You're going to put everything into the bank and then into the market, and then when you okay, so put it all into the market. At the end of the year, you sell. You have to pay this much money back to the bank. Then plus the interest, because presumably there's the interest rate involved. Okay, and then anything else that you get after you sell it, you keep, and that's your profit. Okay. Any questions? Now the trouble is, if your portfolio shrinks in value to the point where the value of the portfolio is less than this, okay, or equal to this, less than the amount of money you have outstanding to the bank is going to make the equivalent of a margin call and make you sell it. Okay, and at this point, the bank will be very happy if you sell all your stock and give the money back to the bank that you loaned to them.
So you're assuming that the interest rate that the interest you owe doesn't accumulate.
Yeah. So in this case, just for simplicity, we didn't worry about the interest rate the interest that you'd accumulated. That's true. Okay. In general, the interest rates are low enough. That's not a big picture change in the picture. But you're right. That should factor in here. So the issue is, if let's say you take this money, you now sell it. This was the added interest at the end of the year. You sold your portfolio for this. This would be your profit. This would be your investment. And you can figure out what the return is on that. Any questions? Okay, any questions about this game? So what do we learn from this? The black line is a leverage of factor of 10. The bank will loan me 9 times as much money as I have right now. My money is leveraged by a factor of 5. And if the market is extremely good, is good at that time, I can make enormous profits. Okay, 600% in a year or something like that. Now, the black lines also show you there's a minus 100 because the most you can ever lose is all your money. Okay? Minus 100 means you lose your money. Plus 100 means you double your money.
Sorry, how can you lose more than your money? Because you have to pay, if you borrowed that money from the bank and you lost it all, then you have to pay back to the bank. So you really owe, you can lose L times X, not just X. Unless you say
Well, the assumption we'll say is that the bank gets to you quickly enough that they make you sell everything the moment your portfolio is empty. Okay? That's somehow what it is. So the bank is going to be watching you every minute. Okay? And the moment that you have used up all your money, then the bank's going to say, get out, give me what you have. Okay? So in principle, the bank's going to make sure you can't lose more than 100%. Okay? And so what is the interesting thing with this strategy? There are clearly eye-popping returns if you can borrow with high leverage. Okay? And the more leverage, this was a leverage factor of 5. In general, right, you would make twice the profit, okay, if you borrow twice as much money, something like that. But what's more interesting is to see that there are times that either, would be the break-even time. You almost never break even. You usually make an enormous profit here. But what's the problem? With a certain non-trivial probability, you go bankrupt. Okay? Any questions about that? If you look at it over the last 10 years, you'll see that doing this during the internet boom decline would have been a very bad idea, right? If you played this game any time in these 2 years, you would have gone bankrupt, okay, with a leverage factor of 10. And in fact, almost any other leverage factor, I think leverage factors above 3 almost always broke you at that point, okay? And now we are living in a time, of course, again, fortunately we cut the graph off before this semester. But clearly, anybody who would have played this game over the last year, okay, it would have also been in trouble. Okay, it would have been wiped out. Any questions? So there are a couple of interesting things with this thing. One is if you want to try to invest in borrowed money, the secret is to be lucky about what time you choose to do it. Okay? That there are good times and bad times. And the trouble is you don't really know what that is like in the future. Okay? Any questions? And, historically when we've talked about risk, usually we measure risk in we've talked all semester about risk in a fairly benign sounding way. We talked about risk as the standard deviation of returns. Another notion of risk is the probability of getting wiped out, okay, of going bankrupt. And that's something that's, let's say, in general, somewhat harder to quantify, but somewhat vivid here. That you'll see that even you have strategies that would give you potentially enormous returns, but would also give you substantial probabilities of going bankrupt. Okay? And that sort of gets us back into this notion of risk-return trade-offs. Any questions about leverage and why it's a good or bad thing? Okay? Perhaps fortunately for you, the bank will probably not let you borrow at a leverage factor of 10 these days. Okay? Any questions? Okay. What I'd like to now talk about, though, is another money management question that is, let's say, a more rigorously mathematical question that's actually kind of an interesting question, is what happens if you have an edge, okay? Suppose how do you manage money when you have things where there are expected positive returns, but there are risks? That's, if you think about it, what we sort of were trying to do here. We knew that if we had bet on we put our money in a leveraged investment, our expected return was positive, although there was still risk. The question of what is the right leverage factor to do, okay, that becomes a money management question. And so we're now going to imagine the following situation. We'll talk about it in terms of games, okay? When you're playing a series of games, if you win, you get W dollars for every dollar you bet. In principle, W's got to be above 1. If you lose your dollar. Okay? the probability of winning is P, and therefore the probability of losing is 1 minus P. And let's say that it's a favorable world. Okay, what would a favorable world be? The probability, if you win, what happens? You have a probability P of winning, W dollars. You have a probability of 1 minus P of losing $1. Okay? So long as the sum of this thing is positive, you have a game that is in your interest to play. Does everybody get that idea? Okay? So now, suppose I'm willing to play you this game. You come into the room with a certain bankroll. Okay? Let's call it B. Okay? And I want to now, you want to play me several rounds of this game. How much money should you bet in each round? That is really right now the question that we want to talk about. Okay? Suppose we come into a world where I'm going to offer you a positive betting proposition. You have a fixed amount of money. How much should you bet, okay, each round to do it? Okay? Any questions? People sort of see what the problem is. Okay? Now, if I come in with a bankroll of B, the first thing I'd like to tell you is the amount of money I bet each time. If there's a right answer to how much I should bet each time, I claim it's got to be a fraction of my bankroll rather than a fixed amount. Okay? So if you look at this problem here, you know what the probability of winning is and the reward, the probability of losing and the punishment. Okay? The right amount for me to bet is going to be some fraction of my bankroll at any point. It is not going to be, look at this, say, bet $10 in abstraction. Because for one thing, I might not have $10, right? It's going to be something that's going to have to be a function of the size of my bankroll. The right issue is to figure out what fraction of it do I bet each time. Okay? And that is what we would like to try to work out. Any questions about that? Let's make it a little bit more concrete. Suppose, let's say, I'm willing to play a coin toss game with you. Okay? This is, we'll say, a fair coin. Okay? If I'm willing to, let's say I'm willing to give you a situation where for every dollar you bet on it being heads, okay? If it's tails, I win. Okay? If it is heads, I will pay you $2.10. Note that in a fair coin game, okay, if we're betting $1, if I take your money if you lose, if it's a fair coin, there was a half chance of it coming up heads, half chance of it coming up tails. Okay? What would be the fair amount for me to pay if we wanted a fair game? If we're playing, let's say, coin flips for money, how much should I return to you? Okay? If you get the coin right. I'm taking the dollar from you if I win. What would be the fair amount to pay back? Okay. 2, right. Does everybody see that? That normally, if you want to play a fair game of coin with a fair coin, tails I keep your dollar. Heads I give you back $2, one of which is the dollar you paid into this. Everybody see that? That would be fair. So if I pay you $2.10 each time it comes up heads, I am giving you an advantage. Does everybody see that? This is a game you should be eager to play with me. Okay? If I'm willing to play this and keep willing to play this. Okay? What would be, though, the right fraction to bet? How much should you bet with me each time, though? This is now the interesting question. Does anyone want to make a proposal? Okay, well, let's think about what the issues are. Okay? One possibility is that you bet your entire bankroll with me. You say, hey, this is a favorable thing. Okay? What would happen, though, if you bet all your money on this coin tossing game? Okay, would that be a good way to maximize your wealth? Okay, what would happen if we played this game 10 times? a game with you every time where you have a chance of winning, okay? You have a positive expectation each time. But in a coin tossing hand situation, okay, half the time you're going to lose. What is going to happen if we play this game 10 times and you keep betting all your money each time? Anyone tell what's going to happen? Lose. You're quite likely to lose. Well, what does lose mean?
It's just certain because if you lose once, you never got a chance to win back.
You see what the problem is. If you bet, let's say, everything, if you say, hey, this is a positive thing, great deal, okay? If we play this game 10 times, there is a 1 over 2 to the 10 chance, or 1 over 2 to the 10 chance that you will win every single time. In which case your percentage gain, which would be in this case, looks like you're making, your percentage gain would compound and you would come out with a nice sum of money. The trouble is that there's a high probability that you will get at least one tail. And if you get one tail, you're completely wiped out. Does everybody see that? So if you bet too much on a game like that, even when you have an edge, okay, there is tremendous chance of you getting wiped out. Okay? And that is, I claim, the wrong strategy if we're going to play this game a lot. Let's say we're going to play this, I'm willing to play this game to you for years, not 10 times, 1,000,000 times. Okay? Clearly it would be dumb to bet all your money every time. Okay? What would be the case if you bet too little money every time? Let's say you bet 1% of your money every time, or a tiny epsilon amount of your money every time. What would be the downside with that? Okay? Right, so somehow that there's a certain compounding rate based on what fraction you're betting. If you bet too little, you're going to be getting an expected positive compounding on the small percentage of your assets. Okay? Your growth rate is going to be lower than it should be, or than it could be. Okay? Any questions? Well, the growth rate here is going to be what is your percentage expected return. So if we play this game, what is your expected return? Okay? We could compute it. I mean, basically it looks like it's going to be something like half the time you're going to be making 5%, I think. Okay? So it's in this particular case, maybe your growth rate might be 2% per coin flip. Right? That's the expected coin rate of growth. Okay? The question is, how can you channel this? Okay, by betting the right amount each time. Yes, let's go back.
If you're defining growth rate as just the expected amount you're going to, does it even depend? If you're defining growth rate as the expected amount that you're going to win, that's what you're defining.
Well, okay, now this is an interesting question. What you're I think what you're saying is, wait, if you're defining the growth rate as the expected amount that you're going to win to maximize that,
Then it doesn't. Okay. Oh, I see. So then I'm trying to figure out where. Okay, W is fixed.
W is fixed.
W is fixed. You're letting P be equal to 1.
W is fixed by the rules of the game. P and Q are fixed by the rules of the game. Your bankroll B is what you walk in with. That's fixed at the beginning. And you're going to keep playing in this casino with this money. Your only decision is how much do you bet each time the game goes on. And the claim that the right way to parameterize that is some fraction, some value F, such that you bet F percent of your bankroll, okay, or F times B on the investment. Okay? If so, what happens? If you bet a fraction F of your bankroll on it, there's two possibilities. If you win, the amount of your bankroll that you did, okay, if you lost, you still have 1 minus F percent of your bankroll. because you only bet F times B. If, on the other hand, you lost, okay, you won, with that F times B percent of it, you won W minus $1 per bet. So if you think about it this way, in this coin tossing example, it paid $2.10 back if you bet $1.
I get that, but what do you mean over here?
Yeah.
Is that if you define growth rate as just the average amount that you come out ahead after one flip,
Right.
rather than taking into account the probability of room,
Yeah.
and room
Yeah.
as something special, then you should just bet, I think FB is large as possible. I mean, if you look at it, basically getting 1 minus P times 1 minus FB plus P times 1 minus W, and we just look at the average return. If you look at
Right.
the average return, essentially the only way that it doesn't even seem to depend.
Okay, so what Mordecai is noticing that he is right about is that in modifying, in maximizing expectation, the right thing to do is to let everything ride every single time.
So
Okay.
So what are you defining as growth rate?
Well,
What's
the question is something like this. Okay? Here is the world that we're living in. Okay? We are living in a world where, again, there is if we bet the maximum amount all the time, and we play this game, with almost certain probability, our growth rate would be a small number of games, followed by wiping out our bankroll and not playing again. Okay? Here we have a situation where, just to give you an idea, an issue here is that the point being that there is a trade-off between the expected growth after n rounds, the expected value of what you have after n rounds, and what your somehow expected growth rate is, your expected gain is after this.
And so
Okay.
is growth rate in essence high value that you're looking at over the
Okay, well, to define it, we have to define this right. The important thing to see here is that there is a bit of a paradox here. Okay? That if you want to maximize your expected value, you bet it every single time for that many rounds. The trouble is that we are probably not so only interested in the expected value, but maybe we're interested in the median value that we have over all possible sequences of coin tosses. Okay? So again, here is just an example of the game, and we'll talk about the exact criteria better later. The green line, this is showing what happens when you play 10%, 5,000 coin tosses. The green line shows what happens if you bet the right fraction, as we will define what the right fraction is. Okay, and this is a log plot, so it's quite a difference. You start out with 100 and you end up with what looks like 1 million. Okay? The blue line shows us what happens on the same sequence of coin tosses if you bet a much larger percentage, 10% of your bankroll. Okay? Because if you bet enough of your bankroll, there's large periods of time when you're going to get wiped out down. With high probability you're going to get wiped out. Okay? And so if you plot your long-term growth rate as a function of the percentage, there is somehow a maximum point, an optimal fraction, which will maximize your expected gain per round. Okay? And betting more than that ultimately produces a negative payoff. Okay? Because you're much more likely to be wiped out. Any questions? If you bet too much, the odds are... Okay, yes?
Okay, if the bankroll is 100 at the beginning,
Yes.
and then if I decide F to be 0.1,
Yes.
and then if I win in the first game, then next time should I bet $10 or $11?
The claim is that you're going to bet the same 10% each time you win. Same 10%. Okay, it's sort of a scale invariant issue. Okay? It's not clear why you should bet a fixed dollar doesn't make sense. If we if I give you a fixed dollar amount, then it depends what currency you're in. You multiply it, are we betting in pennies or dollars? The argument is that it would be a different. If you're betting a fixed amount, it matters whether you're talking about pennies or dollars. If you're talking about a fixed fraction, We're sort of envisioning a fixed fraction here. So what is the claim here? Okay, again, this right fraction is something called the Kelly criteria. And the question, though, is, again, see what the point is that if we just factor in maximizing our expected value, our arithmetic mean, okay, of returns, then we end up with a world where there's a high probability of going bankrupt. Okay? If we bet too little, we don't make what we should. Okay? So here is the situation. Again, if we took a look at the case where we did bet everything, you had a funny situation on that on a particular coin tossing game that we took. It's a different value than I showed you before. There was a 1 in 10 chance you had made $60,000 from one. And the rest of the chance there was a probability that you had 0. Your arithmetic mean was 57%. Okay, 57 times your original investment. Your median value was 0. Okay? So somehow maximizing the arithmetic mean is not seemingly the right criteria here. Okay? Instead, what we're going to look at is maximizing what is essentially the geometric mean of our returns. Okay? Suppose we're going to play n of these games, and we're going to win W of them and lose L of them. Okay? In each game, we're either going to get our win or we're going to lose. The claim is that our bankroll after n rounds is going to be the following. Okay? If we win, we took the fraction of our money that we had won and multiplied it by the winning thing. 1 plus that is going to be the multiplier of our bankroll in the cases where we win.
Sorry, this doesn't seem to match.
Okay? Let's see, which way?
If you win, you have 1 minus W minus 1.
Okay, so there's a question here. The reason why this is a little bit... Okay. Let's see if it does or does not. Okay? Note if we okay, so let's just work. Okay, let's multiply that thing out. That says the reason why it gets tricky here, I'll tell you, is a question of whether the payoff. The reason why sometimes, let's say, it gets confusing is, do you count the payoff as returning the dollar that you had bet, or be over the dollar that you bet? Okay, there's sort of two different interpretations of what W might be, and that's why it's sometimes confusing. Okay? Now let's see if what we're saying here is consistent or which we're actually saying about. This, I claim, would be if I won, okay, I would, okay, so let's just, okay, so what did I say here? Here I said W minus 1, FB plus B if I win. What did I say on the other slide? Okay? Here the claim is, but now let's factor out B. B is the bankroll. What is the percentage that is left? I then get WF minus F plus 1. Is that right? Okay, what I claim is that the difference between here is whether I am going to be returning my dollar to me or not that I bet. Okay, so I'll agree that there's an inconsistency here. But if we interpret it as being that I am going to be, I guess in this case I am saying that I am getting back W for my bet, not making W profit. That is how I'm defining it, and under those conditions I think this is now right. Okay? Any questions? Okay? So the claim would be that if we do it like this, after we play enough iterations of it, if I win, I multiply my bankroll by this. If I lose, I multiply my bankroll by that. My gain after n rounds is this over my initial bankroll, which is this. If I want to maximize the geometric mean of what I am betting here, okay, that means it's going to be basically what I want to do is to maximize the nth root of this thing. Okay? So what is the geometric mean of the gain it would be the nth root of this, which would be multiplying everything here by raising it to the 1 over nth power. If we now consider what the limit of that gain is, okay, as n goes to 0, okay, what we get here is the number of wins over n, the number of losses over n. That's the probability of winning and the probability of losing. Okay?
It seems that this equation assumes that we can survive and run. Right?
It assumes that we're going to be playing this game n times where n goes to infinity. And we want to know how do we maximize the geometric mean,
But
okay, of our game.
what if the money goes negative?
The money can't go negative.
It's infinitely divisible. Infinitely divisible.
We're always taking a fraction like that, so it can never go negative by this measure. Okay, it can get arbitrarily small, but it can't go negative. Okay? So the claim is the criteria that we would want to maximize is the geometric mean as n goes to infinity. Okay? And the interesting thing is that raising it, when you take the geometric mean, you now get probabilities in here, because that's the number of wins over n becomes the probability. Okay? The neat thing is, just like we talked about the value of geometric mean when we count your bankroll, if you play this game n times, your sort of expected rate of growth, okay, your expected rate of gain is g raised to the n. It's sort of like there's the annualized return here. That's what the geometric mean sort of does. Okay? Implicitly, we're using the law of large numbers. We're playing this game a large number of times. Okay? Any questions? So what is interesting? Once we have that formula to find the right fraction here, we take the derivative of it with respect to f, set it to be 0, and then you can solve for what is the fraction that you actually should bet on this. Okay? And the claim is that that fraction works out to the probability of winning minus 1 over the probability of winning divided by the amount that you win, okay, in each round. Okay? Any questions here? Okay? The claim is that this fraction is what people call the Kelly criteria. Okay? And what's interesting is this is measuring the, this is maximizing the geometric mean. Okay? Which is the same as maximizing the log of the arithmetic mean. Okay? The claim is that this criteria maximizes the geometric mean of return, the geometric mean, which is the same as maximizing the log of the arithmetic mean. Okay? Any questions? Okay? So what is interesting about it? This gives us an idea of what our fraction is that we should bet. Okay, this was really defined in a gambling context originally. You go to Sha Tin, okay, or whatever else your local racetrack is. Okay? You have a horse that you want to invest in. Should you invest in the horse, the claim would be that the fraction of your bankroll you should invest in any particular horse race, okay, or coin toss here, okay, would be what we would call the edge over the odds. Okay? W, the odds, is what your fraction of winning is. How much, okay, what your payoff will be if you win. Okay? PW minus Q, okay, is the edge that you get from betting. So suppose, let's say we had a fair coin toss. Okay? Then the amount of gain from when you win, we said, would be $1. If it was a fair coin toss, 1/2 1 times 1 minus 1/2. We have no edge in a fair coin toss. Okay? So if so, that would give us an argument that the payoff there of 1, it would be 0 over 1. It would never make sense for us to bet on a coin toss because we have no edge. Okay? Any question? Or it doesn't pay to bet on a fair coin toss. Okay, if the odds are are sort of such that it's we get $1 if you win and you lose $1 if you are wrong, if you get the wrong side. Okay, so the edge is how much you expect to win. The odds are what the payoff is if you win. And again, when you go to Shatin, you'll see that there is a toast board's odds. That tells you how much you will get if that horse actually wins. Okay? The claim would be the fraction of your bankroll is given by this. Okay? And it would make sense in the limiting cases. You have no advantage in a coin toss, so you shouldn't play coin tosses in a fair coin toss. If you have no probability of losing, okay? If there's never any chance of you actually losing, the coin only has heads on it, then you should bet, then that would say Q is 0. PW over W is going to be 1, okay? And then you should basically borrow all the money you can to bet in that case, okay? Because you can't lose. Any questions? So the neat thing about this game is it starts to enable you to think about a couple of different things. One note that in playing this game, we're not being smart about our predictions particularly. Well, let's say we know what our chances of winning are. But the key issue here is the money management. That when we have a lot in our bankroll, we are in some sense betting more dollars. If we have little in our bankroll, we are betting the same fraction, but that means less dollars. And so we're conserving our wealth for later, so we don't go bankrupt. So if we take a look at this one for the generous coin flipping example, this wasn't the one I started out with before, where we got $2 win if where we made $2 from a coin flip, a fair coin flip, or got a total of $3 back, the dollar we invested plus $2 extra. The fraction would be generous. It would pay for us to bet a quarter of our wealth each time. And our expected gain would be basically 6% per round. Okay? Any questions? Again, notice the difference between median wealth and final wealth. Okay? If we bet the Kelly fraction, okay, our median expected wealth after 10 rounds would be 3.25. That's less than the expected wealth of 57%, of 57 times, which is what we would have had if we bet everything every round. The trouble is that the advantage, though, is that the median wealth is much higher. Here, our median wealth was 1.8, meaning we almost doubled our money half the time. And here, the median wealth was 0. Any questions? So you get an interesting phenomenon here, where if you bet too much of your bankroll, you actually lower what you're making. Okay, even when you have a positive edge. Okay. In a risk normalized sense, because we consider that what we want to do is to maximize our geometric mean. If we're playing this game long term, that is presumably what we want to do. Again, this analysis can be generalized in a couple of different ways. It can be generalized, one, into a case where, before I said you won, if you won, you got W dollars, and if you lost everything. We could perhaps imagine a different model where when you lose a certain fraction of your initial investment. Okay? And you can optimize that criteria here. So in this example, we have a coin flip where we get $1 with probability of half, and we lose half a dollar. Okay? In this case, we double our money with probability of half. We have our money with a probability of half. Okay? If we do it this case, then we have our Kelly fraction as a half, and again we get our 6% gain. Any questions? Okay, and we know there's other generalizations. You can generalize it to the world where you have, like a horse race, many different horses in the race. A probability of winning for each one and a payoff for each one. Figure out what the optimal betting strategy should be then. Any questions? I'd like to talk a little bit more, though, about this particular example, because it's kind of interesting. Suppose we live in a world where we have a half a chance of doubling our money and half our chance of losing our money. Did we ever see any situation this semester where which was sort of like that? Okay? Where half the chance we cut our money in half. With a probability 1/2, we reduced it by a constant fraction. And with a probability of greater than a half, of 1/2, we increased it by that fraction. Was there any model we looked at this semester that was sort of like that? Forget about the question of a half. But we had a model, I believe, where we could start out, we said something, that we lived in a world where there was a certain probability of going up by some constant fraction, right? And a certain probability of it going down by that constant fraction, right? Remember when we talked about binomial trees? So let's imagine we're living in a binomial tree world, okay? Where, if you remember your binomial trees, there are these large, this tree, this infinite tree of short-term events, where at each point there is going to be a coin toss that either multiplies your value by a value of c, or decreases it by one, divides it by c. The net balance, of course, the expectation is that there is no change after n rounds of this. Does everybody see what I mean? You have a lattice of possibilities here, where there is a probability of 1/2 of going up by multiplying by c and 1/2 of dividing by c. After n rounds, you should have no gain. Can we use our Kelly criteria fraction here, though, to make money on this situation? Let's think about this. Suppose we live in a world where there is a binomial tree, a half probability of going up by some constant fraction in each round, a half a probability of it going down by the inverse fraction. Okay? The claim would be that is exactly the game that we're looking at here. Okay? Where with a probability of a half, in this case you're doubling it, and with a probability of a half you're losing it. You're having it. If we do that, in this case there was a calculated gain of 6% each time. There would be a for any constant. Here I happen to be multiplying it by 2. Here I happen to be dividing it by 2. If I multiply it by 1.1, 10%, and go down by 10%, the same thing would be true. In a game like this, the Kelly criteria would give us an expected gain, okay, a growth rate of our money, okay, under this kind of a model, even though the expectation, okay, of what happens to our portfolio, okay, if we held it constant the whole time, would be unchanged. The amazing thing here is that if you put different fractions of it in at different times, you can guarantee or you can expect a return. Okay? Any questions about that? Let me back up a page. Yes.
Because the example you're writing is p equals 1/2, so q equals to 1/2, w equals 1.
So let's look at this example here. We agreed that in a fair coin, which we agree would break even, then I would win $1. Okay, here I'm counting the dollar that I make on a coin. If I bet $1, I win $1 on a coin toss. I lose $1 on a coin toss, okay, on a fair coin toss, right? Here I'm now giving you what looks like a bias in your favor, okay? I am going to double my money, okay, if I, if I win. I bet $1. If I bet $1, I'm going to get back $2, okay, meaning I doubled my money. If I bet $1, I have it. Okay? Clearly this shows me an expected gain. Okay? If I bet according to this strategy, there is a win here. There is an edge. Because in the case of in the case where there was, where the loss was 0 instead of a half, it was neutral. Here I'm giving you more back when you lose. You get an edge with a game like this. Okay? And note that this game is exactly what we're doing in a binomial tree. Right?
Essentially, if you're modeling a binomial tree with an upward trend in the stock market.
Well, it's not quite an upward trend in the stock market. What it is I'm equally likely, a way to interpret this is that I'm equally likely to double my money as I am to have it. Right? If someone offers you odds like that, okay, in the binomial tree model, what would happen? It's not really what do you call it? In some sense, it doesn't seem like a positive edge. If I put my money into this in the binomial tree model, okay, the most likely situation is that there is no, the expectation. Actually, it's not clear what the expectation is, but it's sort of this situation here, okay? The expected number of halvings. I guess what it is this little bit of an asymmetry between a halving and a doubling. That's really what this is picking up on, okay? That if you double your money, you get more dollars than if you have it. Then you lose if you have it, right? Everybody see that? Okay? So we think about what would happen in a game like this.
With the average, if you just play once and bet everything, then you actually come out ahead. So there is an asymmetry.
Right. There is an asymmetry here. Because somehow here, there would be a half of a chance that I would end up with, in this case, $2. Okay? And there would be a half of a chance I end up with $1/2. Okay? So the interesting thing is here, if we do have this case, there is an edge in this model. This is a lot like we talked about the binomial tree model. This is an instance of the binomial tree model. The interesting thing that Shannon recognized, Shannon being the founder of information theory, and a very interesting figure, was that if you played this game using this Kelly criteria, you could now play this game and ratchet in an expected exponential gain, okay, in this kind of a model, okay? And the issue would be if you played this game with absolute dollars, putting all your money in, there is an excellent chance that you're going to get wiped out, okay? So you don't want it, even though there is an expected gain here. The claim would be that you don't want long-term, if I'm willing to play this game against you for 1 million periods, you don't want to put all your money into this game. Because at regular basis, you're going to get large numbers of tails and wipe out your bankroll to a vanishingly small amount. If, on the other hand, you bet at the Kelly fraction, you can guarantee yourself, okay, a relatively, you can guarantee yourself that after a gain, okay, not guarantee yourself, but you have an expected gain of 1.606 to the n, okay? Any questions about that? And so what's interesting here is the difference is not how much better you are at predicting. The difference is just sort of what fraction of your bankroll do you spend so as to stay in the game. That's really what this is governing. Any questions? Okay? So if you use the Kelly criterion and you play this game according to that thing, there are good things that will happen to you. You will maximize the geometric mean of your wealth, not the arithmetic mean of your wealth. Okay? You will also maximize the arithmetic mean of your log wealth, because they're equivalent things. In a long term, in an infinitely long sequence, with probability 1, this strategy will maximize the final value of your wealth compared to any other strategy. You bet the Kelly fraction will maximize the median of your wealth over any other strategy. Okay? It also has a neat property that half the final wealth is actually above the median, and half of it is below it. Okay? So, that's kind of interesting. Okay? And finally, it also would minimize the expected time. Let's say you will be satisfied when you have $1 million. Okay? If you employ this strategy, the Kelly criteria will minimize the expected time required to reach that wealth. Okay, figure. Any questions? So this is, by these definitions, a very good criteria, okay, to invest for money management, okay, and employed by hedge funds in certain circumstances. Any questions? Now the bad thing, though, is that even though this is, that there is still a large level of volatility in your bankroll. Okay? If we took a look, I guess I showed you one example back here. Okay? This was a case, this was a bankroll. You're still seeing very sizable changes, okay, in your wealth. Here was a case where my wealth dropped from 100,000 or 10,000 down to 1,000. Okay? There's still a very high volatility in this game if you employ the Kelly criteria. Okay? So, for example, it can be proven that the probability that your bankroll will drop to 1/n of its original value at some point is 1 over n. So if you start with this strategy, there's a 50% chance your bankroll will drop to 1/2 at some point. Okay? There's a 1% chance it'll drop to 1% of your original value. So although this does give you a good growth rate, there is still a considerable level of risk. You're not going to go bankrupt, okay? And if you are willing to play till n goes to infinity, you will recover, okay? But there is still losses here, or volatility here. Any questions? For this reason, when people actually use this in a hedge fund or something like that, usually people will bet somewhat less aggressively than the full Kelly fraction. Okay? So if you bet, let's say, at half the Kelly fraction, you will get 3/4 of the growth rate of the full Kelly fraction, but with relatively less volatility. Okay? So an argument here is that this can be a better thing to do. Because usually when someone goes into a horse track and thinks that they have an edge, it's often the case that their edge is not as big as they think it is. Okay? And so in this case, betting a smaller fraction is a more conservative thing. And again, it slows down the growth, but not as much as seemingly the improvement in volatility. So here's an example for a particular problem. This was an example of the growth curve for the Kelly fraction. If you bet full Kelly, you got this level of growth. If you bet half Kelly, your growth was 3/4 of what it would have been otherwise. Okay? And at some point, if you bet high enough, your growth rate dips down to negative. Okay? And that's when in the long run, your growth rate will dip down to be negative. If you ignore the numbers on here, if you ignore these values, the answer is, let me think about this for a second. The claim is that I think the shape of the curve is independent of W. There may be limits here. So if the payoff rate was high enough, let me think about this. Okay? This is a curve worked out for a particular example. The x-axis is the Kelly fraction. I claim that that this curve, as a function of the Kelly fraction, the shape of it should be identical. The labeling of what the actual growth rates are problem specific. Okay? But it should be the case that on either side, if you go above or below the Kelly fraction, your expected growth rate will go down. And if you cut it down where you go to half the Kelly, you will be at 3/4 of the original growth rate. Those are parameters of this curve. Okay? Any questions? And just to make this a little clearer, here's this case again, where we are either going to double or halve our money. If we play the game 4 times, if you bet the Kelly fraction, okay, the geometric mean of what you will have maximized, okay, the arithmetic mean of what you would have expected, okay, is lower than it would have been if you bet everything every round, okay? But again, the important thing here that we're trying to maximize is the what you call, this should be, I think, 0. You know, the difference here is that the Kelly fraction maximizes the geometric mean, okay, and going to the half Kelly doesn't decrease it by all that much. Any questions? So the final question should be, as you manage your own money, should you use the Kelly criteria? Should you go and take advantage of these kind of games? And there are a couple of different problems here. One is that, of course, you're in your lifespan only going to make a relatively small sequence of bets. So there are some questions of whether the asymptotics for thinking about these things is the right way for you to think about it. Okay? You might not be comfortable with the volatility. I claim if you had a choice of maximizing the arithmetic mean of your returns or the log of the arithmetic or the geometric mean of your returns, the geometric mean is actually probably the better thing. You know, if you take a look at the coin tossing game, which one of these distributions would you rather have? Would you rather have the world where your arithmetic expectation is very high, but your probability of wipeout is non-trivial, okay? Or is it one that you want that, that somehow gives you on the median a better result, okay? Any questions? Okay? So this is a world where maximizing expectation is not necessarily the important thing. There is in economics a concept known as the marginal utility. What is marginal utility? Okay, it's a question of how much do you value a little bit more of something, right? If you're a starving person, I give you a meal down from the cafe downstairs. Okay, how much do you value it? You value it a lot. If I give you 2 of those meals, how much do you value the second meal? Well, it's less than the original one, right? So in principle, there's normally a law of diminishing marginal utility, okay? That your second $1 million is less valuable to you in some sense than your first $1 million. If we believe that money worked the way food did, that would be true, right? Okay? And if you believe something like this, then maximizing your arithmetic mean is not really the way to maximize your happiness. If we lived in a world where, you know, again, if we looked at one of these deals where we've played this game 10 times, 1/1000th of the time, you made an enormous amount of money, and the rest of the time you were wiped out. This might maximize expectation, okay? But it's expected dollars. But it's hard to believe that this strategy will maximize expected utility in a world where you always made a little bit, where there was less of a cost for, you know, this is where the cost of risk comes in. And the question of what your appetite for risk is related to your marginal utility of money, okay? And I think for most of us, we should realize that you know, in principle, the more money you have, okay, you know, at some point it becomes less and less valuable. Okay, now maybe when none of us are in the room or at the point where that is true yet. But certainly we'd like to think that to Warren Buffett, okay, his next $64 billion is not going to make him happier than his first. Any questions? Okay? And I guess the counter-argument to this, there was this woman who was an heir to the Gucci fortune, okay, who once said that she would rather be rich and unhappy than poor and happy. She ended up murdering someone to get more money and went to prison. So there's a lesson for that, I guess. Any questions here? Okay, about marginal utility and how this thing works. Okay. So if you're interested in this, actually, if you're interested in this formula, there's a popular book on it by called Fortune's Formula that is kind of fun to read. So I encourage you to play with that. Okay, so finally, what can we summarize this semester? What do we know about investing? Again, we've learned that there are various, I think, coherent theories about how prices are formed. Okay? Now, none of them necessarily lead you to a strategy of how you will beat the market, which is what somehow people, in principle, come in here looking for. Okay? But I do claim that if you understand these theories properly in an intelligent way, you can avoid doing stupid things with your money. Okay? You will understand the importance of diversification. Okay? And why somehow that diversification leads to better portfolios than putting in things with the maximum expected returns. You will learn that there is this trade-off of risk and return, and how you feel about that. Again, at the time when the market has collapsed, this is kind of obvious. Oh yes, there is risk in the markets. But I assure you that when the Hang Seng index was going up rapidly, 60% a year, no one felt there was any risk, okay? And it was obvious that you wanted to go for that, okay? And during the rest of your lives, you're young enough that you will have times when it will go up and times when it will go down. You should recognize that if we live in a world of efficient markets, things are inherently unpredictable, and that you're probably better off not trying. When you did the experiments, hopefully some of you saw, how many of you saw that the buy and hold strategy did well relative to more active management strategies? We thought buy and hold did pretty well. Nobody. Who thought it did badly? Nobody. Did anybody implement it? Let's try an experiment here. Who thought it did pretty well? Who thought it did pretty badly? Okay? Well, the evidence is clear. Okay? I guess. Okay? But anyway, that you'll see that somehow that some of these things have, are valuable things. And the idea that if you want to try to think about a long-term horizon, you've got to minimize your risk. Okay? So, all of this says that you can't beat the market, but that is not necessarily an argument that you shouldn't be in the market. Again, one quote I heard that I liked was that the stock market is supposedly a casino that's rigged in favor of the investor. Okay, you go to Macau. Okay, the odds on every time you bet in roulette, you will lose a fraction of your money. In principle, the stock market offers a positive return long term. Okay, and so if you sit out, put your money in and become an old person, okay, in the long run, this is a good thing for you. Okay? So if you want my investment advice, not that it's worth that much, is you stick your money in a broad index fund, okay, with low expenses, and then forget about it and worry about it when you retire. Any questions? Okay? Any questions about anything we have talked about this semester? Okay, last chance. Okay, so what I'd like to just summarize here, just go through the final rules for the for the end of semester game. Okay? We have a final exam. That final exam is December 16th, I believe. Am I right? What time in the morning is it? It's in the morning, is it? Am I right? Okay? I don't know what room it is here, but presumably when I find out, does anyone know what room it is? Or how you find that out?
2464.
You say what room is it in? You think it's in room
2464.
2464 academic building. Is that right? That claims to be the room. I will double check that. If you go there and you find you can't do it, I will have some kind of a sign posted here. So you can always run into the building. You can come back here if you're coming here by habit. Okay? But I encourage you to show up for the right room. Okay? The exam will be, I will be giving you an exam. There will be a large number of short answer and fill in the blank type questions. That's my mode here. True, false, fill in the blank type of things, as opposed to deep, long essay things. Okay? Multiple choice would be better, except that I'm not very good at making multiple choice.
True or false then?
Well, bottom line is it will be fill in the blank. Okay? And there will be enough of the questions that the variance will go down. If I just give you one fill in the blank question, the expected grade for everybody will be the same as if I give you 100 questions. But of course the variance is going to be a lot higher, because if you know it, you know, let's say you know P% of the questions, the material in here. I give you one question, with probability P you will answer it, right? The trouble is then everybody will either have 100 or 0, right? To lower the variance, we have to give more questions. So that's my strategy here, okay? I encourage you to study the notes. That's probably the best thing for you to do, is to read through the notes, figure out what you understand, why was I saying things, okay? And I encourage you to spend the time with that. Any questions about the exam? Okay? True, multiple choice I don't like because it's usually very hard to come up with things to fool you. Okay? I once took in the United States there's a very famous exam called the bar exam for lawyers, which you have to pass. And I had a friend of mine who was studying for the bar exam, and I didn't know anything about law, but I was able to get, you know, a substantially more than the expected value, just because some of the answers were obviously dumb. Okay? So instead, you have to fill them in. That's why we're going to use fill in. Any questions? Okay, so that's the exam. For the project, what I need from you is, at the exam, I'm going to need you to come in with a printout of what your project report is. At the beginning of the exam, it's got to be sitting on my desk. Okay? I want you to mail me any, either a link or the files for anything that you're doing. Okay? It'd be good if that happened before the exam. Okay? But that's a little less critical. I need to actually have the projects here. Okay? Sitting on my desk, printed at the beginning of the exam. Any questions? Okay? Finally, some evaluation questions. I understand that here they have a different system than at my university, where I guess you guys get an electronic survey, okay, and you fill this thing out. I am interested in hearing what you say, okay? So, you know, I somehow got mail that said 10 of you have filled it out, and the rest of you have not. I encourage you to fill it out if you can, just because I'd like to hear what's, you know, this is my first time teaching in a place like this. This is unusual material for me to be teaching, okay, and I'm kind of interested in what the feedback is. I spent a fair amount of time on the lectures this time. Some went well, some may not have done so well. I'm kind of interested in whatever feedback you can give me. Any questions? The final feedback thing that I'd like you to answer very, very quickly is I'm going to pass out now a survey from the instructional video people who are about how useful the videos work. Okay, this shouldn't take more than a minute or two to fill out. But these people are very energetic about evaluating how their video program is working. So for the cameraman back there, okay, he's still taping there. I wave to you. Okay, but I do want you to fill this out, and you know, I won't look at them, so you don't have to worry about anything, let's say, disturbing your grade or anything like that. So fill it out with a pen or pencil, and then stick it in here as you walk out of the room. Okay? Any questions about anything? Okay, if not, fill that out, and then good luck on your exams. And I'll see you guys next time.